Welcome to the Three Questions webcast series. I'm Wayne Baxter, Senior Executive Manager with One Capital Management. On this edition of the webcast, we're going to address the three questions investors should ask about the possibility of lower interest rates. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions webcast series, please consider liking this video and subscribing to our YouTube channel. Now, our process for advising our cross-border clients includes an in-depth discovery and diagnostic analysis of their wealth management goals and objectives. And needless to say, that will include an in-depth review of their investment strategies. For many clients, we allocate a portion of their portfolio to bonds or to bond ETFs. Including the right mix of bonds or bond ETFs in your portfolio can reduce portfolio volatility, minimize the chance of large losses, provide stability of income, and improve the odds of long-term wealth creation and preservation. After seeing short-term interest rates sour in 2022 and the fallout that ensued, fixed income investors now may see short-term interest rates move lower in 2024. Does that mean you should adjust your investment strategy? We're going to address that question and more in this episode of the Three Questions webcast. On this episode of the Three Questions webcast, we're going to review the three questions investors should ask about the possibility of lower interest rates. Joining me once again is Steve Cowley, Chief Investment Officer here at One Capital Management. He's the chairman of One Capital's Investment Committee, and he's also a chartered financial analyst. And on top of that, Steve is a member of the Los Angeles Society of Financial Analysts. Steve, once again, thank you for making time to join us today.
It's always good to see you, Wayne. Always great to take some time out of my day to talk with you. And
well, I've been looking forward to this conversation because, after watching all the I guess the fallout from, the Federal Reserve's decision to raise interest rates from 0.025% to 5.5%, we're starting to see the potential here, at least for the direction for rates change. I think long-term investors, let's just take a look at one thing at the beginning here. Long-term investors who remain fully invested, they ended up being rewarded, as you know, obviously. The ones that speculated, they're the ones that got hurt, but the ones who stayed fully invested, they ended up, at the end of last year, 2023, they ended up reaping the benefits. What is your view of the equity markets in general, at least as we move into 2024? Would you call yourself optimistic, pessimistic, too early to say? What's your view right now?
that's actually a great question. And too early to say might be part of it. I would say cautiously optimistic, a little bit. And the reason I say too early to say and cautiously optimistic, I kind of blend those two together a little bit, is I think that as the year goes on, especially as we get to the second half of the year, things are going to be clearly showing a much improvement. I think we will see we're going to talk about lower interest rates, the Fed doing some things, the Canadian Central Bank also lowering rates. And I think that'll be good. But the reason I say it may be too early to say or cautiously optimistic is we just don't know what's going to happen over the next 3 or 4 months with inflation, with the Fed, with different things. So there's enough uncertainty that we could be in for some more volatile markets just in the short run, as we figure things out and as people, because again, at the end of 2023, when the markets ran and interest rates came down and everything in anticipation of the Fed lowering rates, we may be a little ahead of ourselves. So that's why I say I'm cautiously optimistic, but I'm cautious over the short run. So, but I do, yes, I look forward. I get really excited. We can talk about that a little bit later, but I get really excited when I look past the second half, second half of 2024 and into 25 and 26.
Okay, so historically, presidential elections have had limited direct impact on the markets. Typically, market moves are usually driven by corporate earnings, interest rates, other economic indicators, rather than election outcomes themselves. As we sit here today, Steve, do you see anything that would change your opinion on this time around, and or do you see this time around the election maybe having a bigger impact on the direction the markets are going to take?
I think that history and all of the things that you said, that is a driving force of the markets, and elections are not necessarily the driving force. The caveat I would give I hate to say it, and I don't want to get into politics. And you and I, we've had some fun discussions waiting about politics. Um, and maybe you'll do a webcast sometime down the road on politics. But this one, just because it depends on who the candidates are. I mean, we might end up with a Biden Trump repeat. So the uncertainty and the noise and the hyperbole around that may cause anxiety in the markets. But the reality is, it doesn't matter. I mean, I don't want to say it doesn't matter who gets elected, it doesn't matter, like, all of that. But for the markets, the things that you mentioned, earnings, growth rates, inflation, those are the things that will drive the market. So the answer is, yeah, it should be history. It should be just like we've seen in the past. You might get a little bit because if we get a rematch, people's emotions get really high with these guys. And so there might be just more noise this time around than maybe something else.
Over a short period of time.
Over a short period of time, yes.
Okay, great. Well, we'll move on from the political discussion. I just had to throw that in there. Let's review the 3 questions investors should ask about the possibility of lower interest rates. Question number 1. How might lower interest rates affect the value of my existing equity and or fixed income investments?
So traditionally and typically, that's usually a very good sign when interest rates are going down in the long run. In the short run, it depends on why interest rates are going down. So again, I'm breaking a little bit short and long run. Typically, when interest rates, especially when central banks lower interest rates, and especially if they're aggressive at it, it's usually because the economy is slowed down. It's usually because we're either going into recession or in a recession or something like that. So short run, that signal might be, oh no, things are bad. We've got to stimulate the economy by having lower interest rates. So you might get some short-term volatility, some short-term sell-off based on people adjusting to this new information that's out there. This time, maybe a little bit different. And again, I hate to say it because I tell people all the time, there is no such thing as this time is different. But as we've talked in previous podcasts, the pandemic did change things. And so this is a very unique time frame where we can say this time is different. The Fed printed tons of money. They did it around the globe, but in the U.S., they printed tons of money to make sure that people could still buy their groceries and do that. They printed too much. They created inflation, all kinds of things. And we're seeing the fallout, and we're seeing kind of the tail end of those unintended consequences of all the things that happened during the pandemic. So the Fed lowering rates this time, if they're doing it because they're hitting their goal of having a 2% inflation rate, and they're doing it in timing with that would be a very positive signal. And that's kind of where the markets reacted at the end of 2023, is they think the Fed, with a perfectly clear crystal ball, which they've never had, by the way, saw interest rates coming down. They were hitting their targets, and we weren't going to have a recession, and things were going to just roll into this perfect Goldilocks scenario where they lower interest rates, the economy keeps going, so in that scenario, lower interest rates are very positive for both fixed income investors and equity investors, because with fixed income investors, again, as interest rates fall, the value of your principal goes up because you're owning that. And we're going to get into duration and a few other things that will change that. But so that's very good for investors because they locked in a rate at 5%, and now they get to clip a coupon when interest rates aren't that high. That's very favorable to bond investors. For equity investors, you price your equity based on a risk premium. So if I can get 5% with a treasury and I put a 4% risk premium on that, then I expect to get 9% with my equities. Well, you have to price the equity to get a 9% return, and that usually lowers price to earnings ratios. Well, if that 5% is shrinking, my PE ratio can actually expand, and that pushes prices for stocks up. So usually lower interest rates mean better valuations on your stocks, and it can allow stocks to move on the positive. But this is where, like I said, you need to put that kind of in perspective, because usually when the Fed lowers interest rates is because the economy has slowed way down. We're trying to stimulate things. Companies and corporations are they're retrenching because demand is down. So we're not going to sell as much, and so they're
We're
laying
not
people
seeing it.
off.
We're not seeing as much as that right now with the
Exactly. So
consumer is
that's a
still,
normal.
yeah.
So normally when interest rates fall, especially the short rates, because of central, it's because they're reacting to a real negative environment. This time we're not seeing that. We are seeing slowdown. There's a lot of things that could affect it. That's why I say cautiously optimistic. We could push ourselves into a very low growth environment if we keep interest rates too high too long, if inflation stays higher than it should. But it is generally looking like a very positive outlook going forward with lower interest rates. And it's a signal that the Fed met their goal of bringing inflation down to a very livable number. And they're pretty close to that right now.
Yeah, and I think the key thing is, of course, is that the U.S. consumer. Well, I mean, the unemployment rate is still quite low. We have consumers still, relatively speaking, or generally speaking, the consumers are still spending. So those are the good news, And when if you have an unemployment rate of 3.6, 3.7%, that means most people have a little bit of money in their wallets.
Yep.
They'll spend it. All right. So yeah, you did kind of segue into our second question. Thanks for answering the first one, Steve. So question number 2 is, what is duration risk, and how does that impact my fixed income portfolio? And I'll just add to that is, how does One Capital mitigate these risks to duration risk, relatively speaking?
So it's an interesting question, and it's actually far more complex than I think you realize when you ask about
Well,
duration risk. I think you
I
understand
knew
what it
I
is,
would send you down a rabbit hole a little way. I'll be mindful of the time here on this one, but I will give you a shot at
absolutely.
this one.
I will keep it high level, because when you get into duration and when you get into what it means, it's the actual definition is the weighted average time to cash flow. Let that one sink in for a minute and try to figure that one out. So basically, when people talk about duration risk and what it is, it's how much volatility is in the portfolio. So duration is a calculation you make. Again, like I said, it's the weighted average time to cash flow, meaning if I give you $1,000, Wayne, how long will it take me to get that $1,000 back based on the interest that you're paying me, plus when you pay me it back, and you do a weighted average time of all that. That's how you create or you calculate a duration. Again, it's fairly complex, and there's lots of other things that go into it that we won't go down that rabbit hole. But what that is it's also looking at your maturity. So the longer the maturity, you don't get your money back. So if I lent you money for that $1,000 for 30 years, well, I'm not going to get my money back in 30 years. It's going to be somewhere less than 30 years, but it's going to be a long time. If I lend you that money for 5 years, I'm going to get interest, plus I'm going to get the money back at 5 years. So therefore, I'm going to get it back. That duration number, if you will, is a little less than 5 years. So a duration, why we use duration and we use that number especially, is you're looking at how volatile is your portfolio relative to what interest rates do. So once you calculate the duration number and you make an adjustment to it to make it modified duration, again, like I said, it gets pretty complex. And you take into account convexity, which we won't even go into. What happens is it gives you a number that gives you a pretty good idea of how much your fixed income portfolio will move relative to a move in interest rates. So if you have a longer duration or a higher duration number, if interest rates move 1%, it's going to have a much bigger effect on the portfolio.
Which we saw back in
Smaller.
2022 for those long-term and those with longer duration risks.
And really the first half of 23 as well, you saw that because interest rates continued to move. And again, convexly at the end of 2023, those longer ones, because interest rates fell, had a bigger move forward. So what you're doing is that, so when you talk about duration risk, you're saying how much risk or volatility does my fixed income portion have relative to what's going to happen in the marketplace. So it becomes a very important number because it's what you're trying to say, how much risk should I take in my fixed income? Because you're already taking risk in your equity. So why take that risk or a significant risk in your portfolio of fixed income? Because it's supposed to be fixed income, right? So
the protection of capital.
exactly. So that's what, and so I'm going to answer that question on, what do we do at First Security?
Yes.
Is we there that's a really, really important thing for us. So we're looking at the market, at macro, and saying, where are interest rates going? Where do we want them to go? I'll just give you kind of the history. Back in 2021, 2022, when interest rates were super low, like you said, it was 0.25% at the short rate. Long bonds were really low. As a matter of fact, the 10-year was less than 1%. The duration, like, there was a lot of volatility in that, because that duration didn't matter what you had. It was a long number. It's a big number. And rates were just far too low. And so the notion was that interest rates were going to go up. We just didn't know when. So why
it's a
take
matter of time, right?
Exactly. You don't take a lot of risk in a situation like that. You want to take your risk down. So we shortened our portfolios. We took a lot of that duration risk out of the portfolios. And then in 2022, when interest rates went up and the Fed started doing it, at the end of 22 and through 23, we started extending that duration risk, because rates were getting higher. We were able to lock in better rates. Not only were we getting better risk control with our fixed income, but we were actually getting more income off of our portfolio. So we then moved our risk level out, because we were locking in higher and higher rates, and there was less and less risk to that because those rates were higher. So that's what we do at One Capital. Is we really pay close attention to the macro economy, to inflation, to what the Fed's doing, what's happening, and then we take our best estimate of what's going to happen. Is it going to go up? Is it going to go down? Is it going to stay the same? And then we match an appropriate risk level for the investor to what we think is going to happen. So we'll move that duration risk, if you will, that duration number, plus or minus, depending on if we think rates are going down, we'll extend it out, get a little bit more positive return. If we're worried interest rates are going up, we're going to shorten that up, take a less volatility in that portfolio. So that's what duration risk is. It's really important to understand that. Most people don't, but it's how much volatility are you accepting in your fixed income? And that's not the place to take a lot of volatility. That's the role of the equity market, not the role of fixed income market.
Yeah, and that's why in the short fixed income investors, I noticed that the yields they were getting were not exactly very rewarding, but at the same time, we were able to preserve capital. Where those who were, I noticed this more with clients with 401k plans, where there isn't quite as much they don't have quite as many options. They saw more with their fixed income funds. They were a bigger chance that they could see a larger downturns in that environment, because they don't have the opportunity to go, like we did. I think we were 3 years or even shorter in duration during I guess the most tumultuous time. I've seen a lot of
we were actually down around 2. So
yeah, there you go.
We actually got very, very short. Yeah.
Right. But a lot of the fixed income investments that were available in 401k plans, for example, didn't have that option. No. They didn't have that choice. All right, great. Steve, great job on question number 2 on duration risk and how One Capital addresses and tries to protect our clients against that. The third question is one I get from time to time, and I was really looking forward to hearing your response to this. Question number 3. And again, this is for investors, for equity and fixed income investors this year. Should I consider reallocating my portfolio to equities in response to lower interest rates? So more to equities because we're now in a lower interest rate environment.
I'm going to give you, like I do, I give you 2 answers a lot of times, yes and no's. The answer is, if you were purely a performance guy and that's all you were paying attention to, and you were saying, okay, where's the risk reward? Where's the value proposition? The answer would be yes, you'd shift to equity, because if interest rates are coming down, your valuations are, like I said, if all of those things are you would shift your value to equities, because you have a higher potential for return in equities. You have that pretty much all the time, but when you have interest rates coming down, and if the market is right, the economy forward, then yes, it would be a good time to move a little bit more to equities. So that's my yes answer. It's a purely mathematical.
It sounds pretty tactical to me. It sounds pretty tactical to me, Steve Cowley.
Exactly. And so now I'm going to give you the no, why you don't do that, because I'm not a big fan of tactical shifts like that because you can be wrong as often as you're right. And you're now starting to shift into, and you're chasing something that you didn't necessarily build your portfolio to. So I'm going to go
Mhm.
back and I'm going to say what I say a lot of times is to make a decision like that, you really need to talk to your investment advisor that you're working with to say, is it appropriate for my portfolio? Have we done the proper discovery, as you talked about at the beginning? Have we done the proper discovery? Have we identified the right risk and reward we want to take? Have we identified where we want your money to go? How it's going to work for you in the future? And if the answer is we've already done all of that, then there's no reason to change the plan because fixed income and equity that's part of the plan. It's part of the investment process. That's part of our job to manage that duration risk. So take the fixed income. You're not changing it, but we're going to add a little risk or potential reward to fixed income. We're going to take it off when we don't. I mean, that's the job of the portfolio manager, such as ourselves, to make those adjustments. It's not really. It's a little bit of a speculative, or as you say, tactical move to switch your allocation based on where things are. You're kind of chasing performance. When you chase performance, it's hard because you got to be right a lot. You got to be right to move
Well, the
this way.
thing
You
is,
got to
you can
right
be
to move
really
that.
right or you can be really wrong.
Exactly. And so that's why that's the no part of my answer. If you've done all of the work right, if you have a really good goal and you understand what your money is being used for, and you have that, there's no reason to make that shift. That's
Yeah.
something that you let your portfolio managers manage the risk and how they do that. You talk to your advisor and say, now if things have changed, and you say, hey, I've suddenly come into money that I didn't know, we can
And
rework
you
it. Then
change the
yes,
narrative. You change the story.
exactly. So the answer there is I wouldn't change, because if I've done the work right, if the advisor's done the work right, and you've done the discovery, and you've really thought about your money and what's the purpose of it, and we have a well thought out plan to make that money work for you today, tomorrow, and into retirement, and even for the next generation, then you don't need to make those changes. Now you're just kind of thinking about things you don't need to worry about. Let the money work for you. Let your plan work. And so that's the thing. But have those discussions with your financial advisor, have those discussions, understand what you're doing, because again, you've now changed the risk profile if you do that. And you need
Right.
to understand what risk you're taking to do that. And so that's why, like I said, from a pure mathematical standpoint, when I was saying tactical, yeah, maybe. But when you look at the big picture, probably not. As a matter of
Yeah,
fact, most of
I would say it's a general rule of thumb here. The cash flow analysis and capital forecasting that we do. Uh, but it can help, for example, if you're going into retirement, it can help you determine spending rates and the portfolio's yield, right? And if you do the plan, and really, your stock and bond portfolio will be allocated towards regarding that forecast. So you don't have to change the allocation, right? I think it's
right,
really important that once you get that plan in place, that you stick with it. The only thing that should change, as you mentioned earlier, is if your circumstances change, then that, like, you mentioned, you come into a windfall, you get an inheritance, or maybe the other way around, maybe your situation has changed, maybe to be not quite as favorable. That's when you say, okay, do we need to change the strategy here?
right.
Um, Steve, we're going to wrap up here, but before we do, just any final thoughts? I'm going to just say, in terms of for 2024, just as we wrap up here, any final thoughts you want to share with our audience? So what they should be thinking about for 2024 and beyond, maybe.
I think the best thing, and you actually kind of hit it. We talked a little bit about it. I was gonna make a prognostication about the market being a little volatile in the first half, and it was going to do well next, but that actually doesn't matter. What I would say is make sure that you've got a plan in place, and then go live your life and let the markets do what they do. We're in for a pretty good run. We should have good numbers. We should have good inflation. We should have, growth should be returning. We should be going back, it should be post pandemic. We should be getting on. So make sure your plan is the right plan. Make sure that you've had the discussions and that you're comfortable and that you can sleep at night with your investments. And then just go live your life and let your investments work for you. That's the whole goal. And if you've got a well diversified plan, you've got a great advisor like Wayne Baxter working with you, then you can just, like I said, our goal, our job is to make your life easier, and so that you can sleep at night and that you don't have to worry about your money. Let your money take care of you. Don't don't have yourself worry about your money.
Exactly. You worked hard for your money. Now let it get. Now it's time for it to work hard for you. It was
Yeah.
a motto from days gone by. Steve Cowley, thanks a lot for joining us again. Once again, I really appreciate it. Steve is the Chief Investment Officer here at One Capital Management. Thanks a lot again for making time for us.
All right. Thanks. Good seeing you again.
I look forward to bringing you the 3-question webcasts, and I hope you find them educational and informative. Please consider liking this video and subscribing to our YouTube channel. And to receive a notification of when our latest webcast is being posted, please click on the notifications bell. And lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.